Welcome everyone to our webinar today about understanding the Main Street Lending Program Funding Forward. Please post your questions in the Q&A section only. The moderator will not be able to get to questions in the chat box. A recording of this webinar and slides will be posted shortly on our community site at realtime.inc.com. And later in the day, we will also email a copy to all participants. A little bit about myself. I am the founder and CEO of MultiFunding. I'm an ink columnist writing regularly on business lending issues. I've advised prior administrations on the business lending market as well as the Federal Reserve Bank. I have a book out called The Growth Dilemma. And for my EO friends out there, I'm a proud EO board member of EO Philadelphia. My lawyers asked me to read some disclaimers. We are in an unprecedented time in history, and the information available to us is changing rapidly. Please refer to our most current presentation for education. The information provided is based upon our best judgment about what we know at this time. However, key questions remain about how to implement the program. MultiFunding LLC does not accept any liability as it relates to the timeliness or content of the information we are sharing today or may share in the future, and we are under no legal duty to update any such information or recommendations. We encourage you to check in with your attorneys, CPAs, and financial advisors for additional insights. This is the time for all of us to be reimagining our businesses and thinking about what is next. This is the time to be preparing for battle. And when you go into a battle, you need a strategy. Is your strategy to pivot 5%, 50%, or 90% as a result of COVID-19? Everyone's situation is a little different. What will your team look like going forward? And what ammunition will you go into this battle with? And in this context, ammunition is cash. And in the battle, you need ammunition for both offense and defense. How much cash will be required to get your business back on a stable footing? What is the best case and worst case scenario? Have you looked at all that and thought about that? Where will the cash come from and how much are you willing to personally risk? And what does the future look like? What opportunities were you considering and how will you finance them? That's the vein I want to talk to you about today about the Main Street Lending Program, which opened for business officially this week. $600 billion is allocated to it in the CARES Act. And as of now, it will be in effect until September 30th, 2020. It is comprised of 3 facilities: the new, the priority, and the expanded. Some context I think that is important. This program is not an entitlement program like the PPP. These will not be forgiven. They are loans. And if your business has been badly hit by COVID-19 and you want to try to get one of these, your best chance will be to do so through your existing bank. It's unlikely that a new bank will take on a very difficult credit, even though their exposure is minimal. And if you plan to use a Main Street loan to expand and grow, more banks will be open to you. You will get one of these through your bank, savings association, or credit union. But to be clear, we don't expect there to be more than 200 or 300 banks participating in this program, and they will not be available at every bank, credit union, or on the corner of every bank across America. To be eligible, your business must be established prior to March 13th, 2020. If you have more than 15,000 employees or $5 billion of revenue, you're too big. And you have to be created or organized in the United States or under the laws of the United States with significant operations in the majority of your employees in the United States. Greater than 50% of your borrowers of your assets must be in the United States, net income generated in the United States, and net operating revenues generated in the United States. And your annual consolidated operating expenses will also be generated in the United States. Subsidiaries of foreign companies can apply as long as they attest that the money will not be sent up to their corporate office. Eligible businesses include partnerships LLCs, corporations, associations, trusts, cooperatives, a joint venture with no more than 49% participation by a foreign banking entity or a tribal business concern. Ineligible borrowers include developers and landlords or other certain industries such as private equity groups are not eligible to participate. Affiliation rules apply here. If you have a controlling interest in more than one company, you have to look at the debt, revenue, EBITDA, number of employees of all those companies combined and determine your eligibility. And you cannot exceed the maximum loan amount and you have to pick one facility to work with. So let's dig in and talk about the new and priority facilities first. These share some commonalities. They are a secured or unsecured term loan determined by the bank and depending on your other credit. They have a 5-year maturity. Principal payments are deferred for 2 years and interest payments are deferred for 1 year. The unpaid interest will be capitalized. At the end of year 3, you're going to pay 15% of the balance. At the end of the year, 15% of the balance. At the end of the term, you'll pay 70% of the balance. They are priced at an adjustable rate of LIBOR plus 3%. Currently, you could estimate that to be approximately 3.25%. Prepayment is permitted without penalty, and the fees are 1 to 2%, but likely 2% of points to get in. New facility loans can be between $250,000 and $35 million. So let us begin with an example of row 3 here. This is a company with 2019 EBITDA of $500,000. So the largest new loan facility they could get would be 4 times that, or $2 million. However, if that company had existing debt of $1.5 million, that would be subtracted from it, and their potential loan would be $500,000. You take that same company in row 1, and that company had $500,000 of existing debt, they could get a potential new loan facility of $1.5 million. Really what depends here is, it's important here is the lender's rights. So with a new loan facility, your existing lenders have to agree that the new lender can share rights with them in bankruptcy, but in a normal operating course of business, their rights don't matter. You can set up, depending on what works with the lender, a secured or unsecured loan. And going forward, you can get new loans as long as they don't interfere with the contractual loan obligations of the new lender, but you're not prohibited from getting new debt. Now let's talk about the priority facility between $250,000 and $50 million. Let's take that same company with 2019 EBITDA of $500,000. If they try to get a priority facility, they could go as high as 6x of $3 million. If that company had existing debt of $1.5 million, their potential new money loan would be $1.5 million. If that same company only had existing debt of $500,000, their potential new money loan would be $2.5 million. So you can get a bigger amount with one of these loans. In addition, with the priority facility, you can refinance existing debt into a priority facility. But your lender's rights will have to be senior or on par with all other lenders except for your mortgage. This is not just in bankruptcy, but in all situations. And you can work with your lender to determine if the loan will be secured or unsecured. In theory, a company with as low as $41.66 thousand of 2019 EBITDA and no debt could borrow $250,000 on the priority loan facility. However, we want to be clear that we think very few banks will be doing the smaller loans. Now let's talk about the expanded loan facility, and these loan amounts are between $10 million and $300 million. So to take an example, in row number 1 of a company with 2019 EBITDA of $10 million, the maximum expanded loan facility they could get would be 6 times that, or $60 million. If that company had existing debt of $25 million, their potential new money loan would be $35 million. These loans expand, they tag along with existing loans, and you would work with them with your existing lender to get one. They share the 5-year maturity and the similar payment back schedule and the similar pricing. The fees to get them are less, but likely 1.5%. If you get any one of these loans, you commit to refrain from paying old loans first. This loan facility does not allow you to refinance or pay off other debt earlier, unless you refinance an existing loan into one at the onset. You commit to seek not to reduce your committed lines of credit, and you certify that you have reasonable basis to believe that your business is not going to go bankrupt in the next 90 days. While you have the loan, you can repay a line of credit or including a credit card in the ordinary course of business. You can take on additional debt requirements as necessary, as long as they don't interfere with the rights of your new lender, then you can refinance maturing debt. You commit and agree to certain certification and covenants, specifically around compensation. There are differences for this if you are a tax pass-through entity, and there are certain exceptions. While you have the loan and for 1 year after you have the loan, you agree not to pay dividends or make other capital distributions with respect to the common stock of your business. For those who earn between $425,000 and $3 million in 2019, you cannot earn more than that amount in any year you have the loan plus 1 year thereafter. If there's severance, you cannot earn more than twice your 2019 compensation. For those who earned in excess of $3 million, say you earn $6 million, what you do is you take the difference between 3 and 6, and you divide that in half, which would be 1.5, and your total compensation would be the 3 plus 1.5, which would be $4.5 million. You commit while you have the loan and for 1 year after to make reasonable efforts to retain your employees. But unlike PPP, this is not the primary agenda of these loans. Your EBITDA will be calculated if you're working with a lender you've previously worked with, in the same way that that lender has historically calculated your EBITDA or considered your adjustments. And if it is a new lender, they will have to do it the way they have done calculated EBITDA for companies like yours historically. Your debt will include all existing outstanding and under order available debts, including private lenders and banks, and the debt will be calculated at the date of your loan application. If you have a asset-based line secured by your accounts receivable and inventory, the amount is just the amount that you have drawn at the time, or you're able to borrow. How do you pick between the existing, the new, and the priority? Well, let's take row number 2, a company with $4 million of EBITDA and $10 million worth of existing debt. They could get a new facility of 6, a priority facility of 14, or an expanded facility of 14. And it would really depend upon what they can work out with their banks, what their needs are, and what makes the most sense for them. Financing strategy is like playing offense and defense. Let's talk about 3 use cases that people are considering these loans for. Example number 1 is a company with a $3 million line of credit and $1 million drawn. The line of credit has a personal guarantee, and they are planning on getting an MSLP for liquidity. They would rather not personal guarantee the capital required to reestablish the business, and that's why they want the MSLP. However, I want to be clear that most lenders are, even though they're not required to, still requiring personal guarantees on these loans. Example number 2 is a professional services firm whose partners will reduce draws by at least 50% in 2020 to recover from COVID-19. They plan to take an MSLP to spread their income hit over a few years instead of 1. And number 3 is a company that has already been approached by several competitors who plan to close shop. They plan to acquire companies at pennies on the dollar and use the MSLP money to help. How much money will be required to get your business back on a stable footing? What is the best case and worst case scenario? Where would the cash come from, and how much are you willing to personally risk? And as you ponder your future and look forward, what will the opportunities come from? What is your strategy and your war plan? And how much ammunition and cash will you need? With all of that being said, we're now welcome to open the floor to any of your questions. Thank you so much.
Thank you,
Anna,
Ron.
the floor is all yours.
What about compensation for owners of an LLC who work?
And the compensation is limited to what you took out in 2019, as long as that was, if that was in excess of 425,000, you're capped at that amount while you have the loan in 1 year thereafter.
What about buying a business with Main Street funds? Are there limitations?
There are no limitations, but each bank that you talk to, some banks are looking at that as a favorable use of proceeds, and some of it are looking at it more nervously.
Do you know of any banks that are currently accepting applications? We have not had any luck yet, and it appears most are weeks out from being able to do so.
We do have banks, and we are working with them, with our clients right now, and we have applications in underwriting.
And we have one more. It's an EIDL question.
Sure.
We applied for the baseline forgivable amount and received it. Can we apply for more through EIDL now that we understand that it has reopened with more attractive loan terms?
Assuming the first application was for the $10,000 and now it's open, I believe you can.
If you took 100K in comp in 2019 from an S Corp, can you increase that to 425K in 2020 if you get an MSLP?
I believe that's the case, correct.
We have no questions at the
You're
moment.
you're an easy audience, folks. Any other questions? Questions going once, questions going twice. We're going to wrap it up. Anything else, Hannah?
That's it. Thank you so much, Ami.
Thank you very much, everyone. Have a good day. Take care now. Bye-bye.